Joining me now at Post 9 to make sense of all of it, Chris Hyzy, CIO of Merrill and Bank of America Private Bank. Got a nice little move here. Good to see you.
Yeah, good to see you, Scott.
Market likes this Treasury funding a little bit less than anticipated. Yields came down and stocks jumped.
Very similar to late last year when we had the big 2-month move afterwards. It's, you take the wedge out of the market. Most of last year was the inflation wedge. That was removed. Then it became a yield backdrop, wide deficit. Where are we going on the 10-year? Took that out. Now it seems to be this slow drumbeat, once again, of taking that yield wedge out of the market. Obviously, it's just one announcement, but it's a big one.
Does it last? I mean, do you think where the market's come to in a pretty quick, 3-month period of time, that it's justified and can continue, has more legs?
Yeah, I think we've been covering the markets for quite some time, both you and I, and when you see something priced in like that, it's justified because it's priced in. Question is it going to have follow through? I think that's where you're going.
Well, yeah, I mean, let's put it this way. Let me be more specific. Yeah. Are valuations justified of the market, right? Dr. Jeremy Siegel was on with us Friday, said, well, I mean, 20 times is not exactly cheap, but he still thinks we have more to go.
I'm not so sure it's important to look at the valuation levels today and say, I remember when. Right? The makeup of the market's different, et cetera. But if the market's willing to price this in at these levels and they have certainty, X geopolitical activity. So, for instance, certainty that this next week of big-time earnings are going to be relatively decent, and they're happy paying that, great. If yields are coming down, inflation coming down, and financial conditions are still easy, yes, I think those are justified.
So I like the way you put that, because it's not like we ever have, complete certainty. It just feels today we have a lot less uncertainty than we did over the past 12 to 18 months.
Especially the two most important jobs when it comes to what our worries are, the Treasury and the Fed. And when they're working in concert together, it makes people feel like it's okay to take a little bit more risk.
Goldman's doubled down today with their March call. I think there's going to be a cut. What's your house view? What's your view?
House view is March.
It is also.
Yeah, it's still there, and it's quarterly from there. A very measured, moderate pace of removing the excess real yields that are out there overall, or absolute yields. That's our call. It's going to come. We have 2 more CPI prints, right, before then, and jobs. It's jobs, right? We'll know in the job market if we're turning from soft landing, which is basically the drumbeat of Wall Street, to a harder landing, over time.
Well, I mean, there's no indication that we are.
No, there isn't.
Right, and I don't think, a few days from now it's going to be telling much of a different story. There's no indication anyway that it's going to, right?
Yeah, I completely agree, and that's one of the reasons why this transparency factor is staring us there. And we know the playbook. Mm-hmm. And if the playbook doesn't change, then you can continue to go to new highs.
So conventional wisdom would say, okay, if I believe what Hyzy's saying, that would suggest that I want to go into these broader areas of the market. I want the small and mid-cap names, and I want these more cyclical names that aren't all condensed into these large-cap stocks.
Yeah.
Why is that not working lately?
I think because the comfort level with a good portion of the lower quality areas of the market isn't there yet. They're waiting for a few signs that those unprofitable areas can turn to a little bit more profits, and they're very comfortable owning the areas that have been working. And what's that flare gun that goes up? Maybe, just maybe, it's the first couple cuts that the Fed engineers.
Do you like the other areas of the market, or are you still, mega caps are the way to go?
We're still high quality. We are still mega caps. However, on our upgrade watch list has been small and mid-cap stocks, some parts of value. What's driving the market right now, and you see it every day, Scott, is more the factor end of things. Last year it was interest coverage. This year it's earning momentum. Until that switches to the broader part of the market, these are subtle head fakes, but it's good to see the basing out.
And you think stocks and bonds are going to go up together this year? The yields are going to continue to come in?
Yes. This is a road to normalization. Now, is it going to last all year? It's not that easy. But a stair-step type of grind it out, climb the wall of worry, great transparency, yields coming down, inflation participating the way we want, resilient job market, resilient consumer. Yeah.